Hello everyone, my name is Matthew Frailey. I started Breakpoint Trades back in 2003. Been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms like you see here since 2003 for individual traders and professional institutions, which I consult with on a weekly basis. Anyway, it's been a little while since I did a market video, so it's going to take this video will be quite detailed, guys. It's not meant to be a quick 10-minute video to grab your attention, so sit back and watch and listen if you are interested in the markets. Forewarning, this video may take upwards of an hour. We're going to cover everything in detail. If you haven't subscribed to Breakpoint Trades, you should consider doing so, because in doing so, in addition to seeing our video here, you'll get access to our live charts, live signals to our systems like you see here, etc. So let's get started with this week's analysis. This here is the admin of my newsletter recorder. And so this is what I'm going to use to record the video. These are the audio slides on the side. So let's get started with this. Hello everyone, this is Matthew Frailey with BreakpointTrades.com. First off, hope everyone had a nice weekend. It's Sunday afternoon. It's about 1 p.m. Eastern Standard Time as I'm recording this video. And this is the weekend market newsletter for May 22nd, 2022. You can see this newsletter is divided into 7 major sections. These weekend newsletters are quite detailed. First off, I'm going to go over my opening discussion and observations. We'll then do a deep dive on the major indexes. We're going to look at the big picture, long term, intermediate term, and short term. We'll look at important indicators that we follow: bonds, treasury yields, major sectors, cryptocurrencies, many of the commodities, and follow up the US dollar, precious metals, and gold stocks, gold miners. So again, here's a summary of what I observed in all the charts. If you have the traditional newsletter, you can pause and read this. I suggest you do that, or perhaps you can read this on YouTube. So my summary is that market, indexes did close down for the week. The Dow lost about 3% as the S&P. The Nasdaq lost 4.5%. The Russell lost the least, 1.1%. Out of the 21 sectors that we follow, only 6 of those sectors closed positive: energy, metals and mining, and biotech. The other 15 sectors were down, with transports and consumer discretionaries having some of the biggest losses, and retail. Okay, Walmart, Costco, Target, they had historic sell-offs last week. US dollar pulled back quite nicely. We've been looking for a high in that. Bonds, TLT, had a nice bottom a couple weeks ago, which we identified, and the 10-year treasury yield has been coming down, which we also favored. As far as commodities, they were mixed, with crude oil slightly up, copper up 2.4%, the ag grain area, which has been very strong, closed mixed, and the precious metals closed up nicely. Now, here's what I'm seeing, guys, short term before we get into the charts. Short term, it's possible we put in a trade low last week. On Friday, we had another sell-off. Everyone's been looking for the VIX to spike. It did not spike. It was pretty obvious it wasn't going to. We also had the VIX options expire last Wednesday, so that was kind of providing a ceiling for that. But we had, on Friday, a lot of the major indexes and most of the sectors produced long-legged doji candlesticks. Many times you get market inflections at that, but you need to see confirmation. You need to see price take out the high of the dojis. But we have these long-legged dojis. Another thing, the S&P tested 3810, which is basically the 38% Fibonacci retracement from the March 2020 lows to the 2022 highs. That was an important target for a lot of technicians. We bounced off of it. The triple Q's got around the 50% fib retracement. Longer term, we're looking for much lower prices, but that was some initial major levels. We also have a lot of positive divergence across to many indicators that we track relative to the market, such as the McClellan oscillators, equal weighted indexes, emerging markets, things like that. So there's a lot of things here that point to a potential trade low. My concerns are that we need to see follow through on the dojis. We have a possible coil setting up on the VIX 60-minute, which if that breaks to the upside, well, then the market's going to have another leg down. The triple Qs, there's an open gap at 275 that did not fill, and we got close enough to that gap that it makes me nervous. Most of the time you want to fill those gaps. We did not. So if we go down again, we could fill that gap. The cryptos need to rally too. They lead. If we do, we also could have an intermediate term low. And what I mean by intermediate term is, a trade low that lasts for 1 or 2 months into the summer. Long term, our stance has been that we're in a bear market. We've been calling that since early January. We got extremely cautious last year back in November and December. Even before that, that call ended up proving out, super well. Everyone's pretty much on the bear camp now. But let's say we have an intermediate low right now. Long term, we're in a bear market that I expect is going to take quite a long time to unfold. This would maybe just be the first major decline, the first early innings of a bear market, like the first or second inning. Okay. Considering the excesses we had in the last bull market, well, we had a 13-year bull market from 2009 to January 1st, essentially. So just by odds, you're due for a bear market, right? You had the Fed has to raise rates. They're cornered. They're boxed. You have a slowing economy. You have rapid inflation. You have supply chain issues. You had all this rampant things typical in the final stages of a bull market that I think need to be washed out. And that's going to take time. And kind of like one of my graphics here, this is the NFT craze. That's been crashing. But, some of these ETFs or these NFTs, this one here, the first 5,000 days sold for almost 70 million. The cat, Nyan cat, seemed like a bargain, 580,000. This little crazy thing here, CryptoPunk, sold for 11.7 million. And one of the funniest things are these NBA highlight reels that the NBA was selling for 200 to 250,000 a piece for 20, 30-second game highlights. To me, all that stuff was speculation, born out of the speculation of the blow-off bull market, right? And I think a bear market will wash all that crap out. But that was kind of some of the final stuff you've seen in the end of the last bull market, the crazy stuff. And that's typically, what you see with that. I think, bear markets are about kind of washing away all that kind of stuff and resetting things. And that takes time. Bear markets are not a quick 20% correction like CNBC says. They last sometimes, 1 to 2 or 3 years because you need that amount of time to cause frustration to change long-term psychology. All right, so let's go ahead and get started. So item number 2 shows the index sector table, what transpired last week. So again, you can see the major indexes. Closed a mix on Friday. We came well off those lows. As I said, we formed black candle doji candlesticks on the indexes, possible reversals. For the week, all the indexes closed strongly down, as you can see. But again, quite a bit off the lows. For the major market sectors, most sectors closed down for the week. About 6 sectors here closed up, as I already stated. So in the biotech, drugs, and energy. All the other sectors were down, especially retail was the weakest, down almost 9.5%. Consumer staples, consumer discretionary, transports. The U.S. dollar had a big pullback, down 1.5%. That helped the precious metals. Remember, the dollar was at some resistance, had a divergence building. That's playing out. Cryptos were mostly down for the week. They followed the market. Keep an eye on these guys. They lead the markets. Over the weekend, they're kind of flat. Commodities were a mixed bag here. Natural gas was up pretty nicely. Copper, weakness in the ags, and crude oil was flat. Nice moves in the precious metals, and of course, the 10-year Treasury yield continues to fall, and bonds continue to rally, which is with our call 2 weeks ago. Next. Item number 3 shows the economic news calendar for this week. May the 24th, that's my birthday. You can see you have PMI, new home sales, and you can see what's on the docket for the rest of the week. Okay, let's jump to the index charts. So the first chart below, item number 4, is a yearly snapshot of the major indexes with these Bollinger Bands. So far, this says as of May 9th. I forgot to update that. This is as of May 22nd, today. So Dow down 14%, S&P 18%, Nasdaq 27.5%, DBC up almost 35%. Remember, my newsletter's on December and January, I called for a bull market in commodities, and that's been the case this year. Bonds have been ugly, down about 20% for the year. That has not helped the diversification crowd. If you're with AG Edwards and they have you in a bunch of bonds to help your stock portfolio, not helping this year, is it? Next. Chart number 5, here's a monthly view of the indexes. Again, Steve and I talked about this blow off. Essentially, after the February-March 2020 COVID crash, the markets rallied up. This was a blow-off move of that entire bull market. And we talked about us needing a bear market correction to work this off, and so far that's what we've done. Dow, S&P below those middle monthly Bollinger Bands. The Nasdaq is already near here, so could be a little support area. Next. Chart number 6, here's a weekly view of the indexes. One of my concerns that I didn't mention above is, but I have it in text, the weekly candles are not pretty here. They're not that indicative of a trade low here, but again, these are weekly. You know, we have daily dojis, so we'll focus on those, but here's the weeklies. Again, bear market or bull market high in 1st of January. So far, we've had essentially 2 declines in this bear market. Okay. Next, chart number 7, here's a daily view of the major indexes. So short term, what you see here is these tight downtrend channels. Ultimately, the bulls need to get out of these channel lines. But on Friday, you have the hope is you have these black candle dojis. You can see it here on the Dow. It's kind of like a hammer, taking out the high. Could be a long trigger with a stop immediately at the low. Now, again, you want to get above you want to see price follow through, get above the 9 EMA, get out of the channel. With all these, if you can have a strong up day on Monday, that would provide a bullish morning star pattern. So really you need to see follow through on these indexes, guys. If we can do that, that would be a good sign that we have at least a trade low here and for a bit. But bulls have the football, or they may have fumbled it from the bears on Friday. Now they need to see if they can run with it and get a morning star candle here. Next. Let's move to the S&P 500 charts. Here's a monthly view of the S&P, chart number 8. So way back, you can see my comments here. This is a monthly view, so each candlestick is 1 month. Steve and I talked about this last year in August, September, October. We talked about the super wide moving average ribbon on these monthly charts. We said this was unsustainable. It needed to work its way off. And lo and behold, this played out. Again, you can pull our newsletters up from last fall. We talked about this needing to work off, and we said it would be quite a long time and price. And so far, it's doing it. But it still's got a long way to go for this to really work off. But, bear markets are not one decline. I consider that this may take time. For example, something like this, rally up, and then sell off again. Okay. Next. Chart number 9, here's the monthly view of the S&P that we've been showing since last year. This channel, we had that bull market begin in March 2009, essentially a 13-year bull market, which ended basically at the end of December, beginning of January. And, we're in a bear market. So this is the decline we've had. Generally, bear markets, I did a review on this in the past, will retrace at least 38% of previous bull markets. So that puts an eventual target down here around 3,200, around this channel line. I think over time, this bear market has potential to go much below that. And I'll give some evidence below, but this has been our view since the beginning of the year, bear market. Next. Chart number 10, here's a logarithmic chart. So long term, these are some of our target areas. So this is added fibs from the March 2020 low to the highs. So on Friday, we bounced off this 38% fib. Maybe a good area to bounce in the short term here. Longer term, this is one of our targets, the 61.8% fib retracement of this whole move from the March lows to the recent highs. And even these trend lines on this logarithmic chart below. Next. Chart 11, here's a linear chart. And I'm showing this because the linear chart shows you how the last couple years since the March 2020 low essentially ended in a blow off. You could see the slope of this bull market here. Let's go ahead and draw it in. You know, it was a nice uptrend slope. And then you can see it essentially, the slope doubled in intensity here. Classic blow off, this whole move, right? So this is one of our targets, like I said, the 61.8% retrace from here, this low to this high. But when I looked at past bear markets, when you get a blow off like this, most of the time you retrace that whole blow off. So I think there's potential long term for this bear market to come down here. Again, guys, that's going to take time. That if that occurs, that may not occur until later next year. All right, don't expect that this year, but it's possible if we get a bounce in here. So we get a little bounce in here into the summer. It's possible that we get down into here this year, unless we were just crash here and get down to here now. But these are my targets long term. All right. Next. Chart number 12, here's the Nasdaq, and it shows that classic blow off from the late 90s into 2000. So again, you had a long bull market which began in the late 80s, and it ended that last year and a half with that blow off move. And that was all retraced here in that bear market and even a little bit more. All right, so that's some evidence. Next. Chart number 13, here's a weekly view of the S&P. This is one of our trend systems. It's useful for 401k type plans. The DVTs provide higher lows for a stop. Think of it like a trailing stop, like a protection, like an insurance plan. These were stopped out in early January, and they've stayed out. They did not go back long on this bounce. In a bear market, this easily won't go back long. This is more useful in bull markets, okay, which we're not in. Next. Chart 14, here's the daily chart. Then the daily did attempt a long back here in March, but then it quickly got out, and it's been flat ever since. All right, so these trend systems, again, they're mostly going to be out because we're in bear markets. And a lot of the longs in a bear market could be like this, kind of very choppy. You either make a little or it ends up being a whipsaw, okay? I don't expect the daily to go back long here for quite a while, so please be aware of that. I wouldn't follow this right now to go back long on the market. It'll get in too late, kind of like it did back here. Short term, we do have, you can see the doji. We have some divergence on my derivative indicator here, which is the second derivative of these moving average ribbons. Next. Chart number 15. Here's a half-day chart of the KISS system. I may post this and a faster 60-minute because these possibly could trigger pretty soon. And if they do, they at least get a pretty tight stop, unlike the dailies in this type of market. Next. Chart number 16, here's a weekly view of the S&P. As I stated, Friday's lows was 5 points off the 38% fib retracement from the March 2020 lows to the January 1st highs. So this was a target area of a lot of people. Again, longer term, our target area is at least down in this range. I don't think we get there now unless we just crash. And so we'll see. Next. Chart number 17, here's a daily view of the S&P. So you can see the decline this year so far. We had a couple declines here, January into March, then a decent rally. This was an awesome shorting opportunity. I did not short enough here. It should have been more aggressive. And waterfall decline since, very tight. You can see what happened on Friday. We've been trying to bounce around this zone. Get the black candle doji. If we could take out the high of this doji, which is 39.43, that would be a positive. If you get an up candle, that would be a morning star. So you can see the lows got within these confluence of trend lines. We have some divergence on the RSI. Moving average ribbon's pretty wide. You can see when they get too wide, you get a reversion to mean. Little divergence on the MACD, little positive divergence on the CCI. So you have some evidence here. You know, if the market wants to try to rally here, this is a possible area to do so. Next. Chart 18, here's a zoomed in view of the daily. So again, you can see the candle. Again, an objective long setup would be taking out this high of the doji, put a stop at the low. Again, we have some divergences here. Now, if we get an up candle, ultimately it needs to have any good legs, it's got to get out of this tight channel. That means closing over the 90 MA, closing out of this channel. And it's going to have work to do. This will be first big resistance here after the channel, you know, and the 50-day. Next. Chart 19, here's a 2-hour time frame. So last week, we had that big rally into Tuesday. It stalled right at the downtrend channel. We said it needed to get out of this channel to keep going. It did not. It ended up being a good short area. And then Friday, we pulled back into here. We bounced right around this extended trend line. You have some MACD divergence, RSI divergence. So everything's set up here to bounce if it wants to. If we get a follow through, again, you need to get out of this channel like we said it needed to back here. But this is an objective area to try along with a stop down here. Next. Chart 20, here's a 60-minute view just showing the same channel. Again, this is your main resistance up here. We'll see if we get follow through. Next. Chart 21, here's a 30-minute view. It's showing you the same things. You can see the channel lines. One, you could draw a downtrend line from the April high here. You could also draw one from the early May high. Gets a little bit lower. And you broke a little downtrend line on Monday here. So again, if you're long, put a stop right here at the lows, essentially. We have some MACD divergence. We'll see if we can get follow through. Next. Chart 22 is another 60-minute chart without any indicators. Again, we've been stalling at these resistance trend lines, resistance supply zones. So those are your areas to monitor on a bounce. Finally, chart 23, here's a 3-minute chart showing you the action on Friday. We sold off, bear flag in the morning, sold off. And then guys, from an educational standpoint, remember my Symmetry video. This was your long opportunity. You broke Symmetry here, intraday. This was your biggest bounce in the morning. It was exceeded here, and that told you with high certainty to look for a higher low. So if you sold this bounce, you had a nice aggressive entry here and then right here. And then you had that big end-of-day ramp. You can see your moving average ribbons pinching extremely hard here. Energy was pent up. So big move up, and that's typical on these option expiration like you had on Friday. But you had a nice objective day trade setup here is what I'm pointing out on Friday. Next. Chart 24, this shows you the cycles on the various time frames from the daily all the way to the 60-minute. So on all these time frames, we're still below the ATR indicator. That's resistance, ATR. We need to get over that short term. Next. Let's move to the triple Qs, chart 25, weekly view down 4.4%. Again, that's not a pretty candle on the weekly. You know, we're around the 50% fib, and you can see longer term target down in here, 61 fib. And I think eventually over time, even down into this range. Next, chart 26, here's the monthly view again. We got, we're right around the 50% fib here, 61.8% fib in this zone, which is one of our targets this year. You know, on a really deep bear market, I could see something down here, but probably not this year. Okay. that basically retracement of that whole blow off move. Next. Chart 27, here's the daily view of the triple Qs. Again, we're in this tight channel like I showed. On the indexes, we have divergence. We'll see if we can get follow through. Price needs to get follow through on Friday. It needs to get out of this channel. Again, moving average ribbons are pretty stretched here, so energy is built. Next. Chart 28, zoomed out view of the triple Qs. One thing that annoys me, that bothers me on the back of my mind, is we did not fill this open gap. I thought we were going to fill that on Friday when we were selling off, but then we reversed. It's around 274.50 from the November. These open gaps like to fill, and when you get too close to them, usually you fill them. So it does bother me that we not fill this. If price sells off, reverses down again on Monday, early this week, this would be my immediate target, guys. Next. Chart 29, here's the 60-minute view. So I talked about this on Wednesday. I said to look for a potential double bottom because we had a little symmetry break, but we did end up making a little low here. So again, this is your main symmetry to monitor, about a 22-point move since the downtrend in late March. So if the Qs can have a rally bigger than 22 points, that'll break symmetry. Be a positive. Next. Chart 30, here's the trend daily system for the triple Qs. Again, they're in cash, as you'd expect, a trend system. You can see they went back to cash in December. Then they attempted along here in March. Went up a little bit, and then it got out. Again, the daily's not going to trigger back long easily here. Longer term, this ATR could be a target on a decent rally. Next. Chart 31, here's the cycles. Very similar look to the S&P. The ATR short term is your resistance on these smaller time frames. Next. Chart 32, IWM small caps. This is the non-dividend adjusted one. You can see how this played out last year. We had a little blow off move here on the weekly. MACD divergence. You lost support here. Broken support was retested as resistance and then down. There's an open gap down here that would also be a target of mine if we get immediate sell-off again. Okay, right around this 165 area. Next. Chart 33, here's the daily. It did not take out the lows last week, so be aware of that. Next. Chart 34, here's a 60-minute view. So the one thing I pointed out last week was IWM did have a symmetry break here, so I said it may attempt to make a higher low, and so far it's done so. So there you go on the indexes, guys. Now let's move and look at some of our market indicators. Chart 35, here's the NASI summation index. I'm just showing you this because this thing gave a warning way back last July, August. Basically, this is when a lot of the stocks underneath the surface of the market index have started selling off. This is an early warning, and we talked about this last year. This was well before even November. Next. Moving to the VIX, chart 36, here's the VIX. Has a potential diamond here. This could break either way. Keep an eye on this. The VIX, a lot of people have been looking for the VIX to end on this final spike up into the 40s and 50s. We're either going to get that now or we're not, okay? If we do get that, then the market will have a flush. Next. Chart 37, here's a 60-minute view of the VIX. Shows a possible bullish coil. Wave D would have formed, and we'll make a higher low D and then a higher low E and then rally out of here. This concerns me. If this occurs, then the market will have another move down. So watch this as well. Next. Chart 38, here's the VVIX. You can see it gave 5 reliable sell signals on this decline from late March. Okay, even this last one, which was pretty late. Now, the VVIX is back below 110, so you would no longer be in the short because it fell below 110. Next. Chart 39, this is the Nasdaq, and this is the NAHL, new high, new lows. It's like a McClellan. So you have a divergence here as this is going up while price made a new low. One thing I want to point out is a couple of these very simple indicators. The percentage of stocks above the 200-day and above the 50-day. On the 200-day, it's buried down here below 11%. The 50-day, you have a divergence here, positive divergence. You had a divergence last time, and then we had that decent March rally. Next. Chart 40, let's zoom out a little bit. So here's the same indicators zoomed out to 2015, and you can see the percentage of stocks below the 200-day moving average buried here. There's the 2020 lows, 18 lows, 2016 lows. So it's down in this range where you had some of these decent trade lows, even on the 50 percentage of stocks in the 50-day. Next. Chart 41, here's even zoomed out further, back to 2006. So again, you can see how it is at levels that was last near pretty decent major lows. And here's the 2008 time frame. It was obviously lower then, but interestingly, that was at the final stages of that bear market. You know, presumably we're still early in the bear. Next. Chart 42, here's the put-call ratio. Here's a positive. The put-call continued to decline while the market was making new lows. Kind of a positive divergence. You had this occurring last March, and you got that rally. Next. Chart 43, here's the NYSE advanced decline. You also have a divergence. So far, you have a higher low in place, lower low in the S&P, so a positive divergence. Next. Chart 44, S&P McClellan, same deal. S&P made a new low here. This did not. Next, chart 45. Here's the S&P versus the bullish percent S&P. Higher low so far, lower low in the S&P. So a positive divergence between these indicators. Next, chart 46. The S&P versus the value line. Okay. Usually they move together, but you clearly have a divergence, positive divergence, with the value line not making a new low, the S&P making a new low. Next, chart 47, the triple Qs versus the triple Qs equal weighted. You also have a same positive divergence in place. Next, chart 48, here's another one, S&P versus emerging markets. You have a positive divergence here with both of them. So you got a lot of divergences here supporting a potential trade low if the market can follow through, guys. Next. Chart 49, here's an interesting one. This is the S&P above here. This is the semiconductor to Qs ratio. Look at this divergence between semiconductors, how much they're outperforming the triple Qs. Quite a divergence. Next. Chart 50, here's the Nasdaq with the highs minus the lows. Again, it's far away from zero, but remember, guys, on a good bear market rally, if this gets back to zero or even a little above it, that'll be a good short opportunity. This has given excellent signals this year when this gets up near zero. Very useful in bear markets. Next, chart 51, here's this indicator back in 2008. You can see how it worked very well during that whole decline. All right, that does it for the indicators. Let's move to bonds and treasury yields. Chart 52, high yield corporate. This did rally off the lows so far. This needs to see follow through. This has been very weak, leading the market down. Next, chart 53, TLT, 20-year bonds. A couple weeks ago, I called for a little parabolic washout low down here, and so far we got a low in place. Little ABC action, measures up higher. Next, chart 54, here's the 10-year treasury yield. Last week I said this looked like a head and shoulder. It's starting to play out. Now the 50-day moving average here will be a support. Okay, if that's lost, the market would really like that, because that would help long-term rates come down a little bit, and the market maybe could have a relief rally. Next, chart 55, there's the weekly view. Again, hell of a move in rates this year out of that coil, as expected with the Fed. You can see how wide the ribbon got here. Gets too wide, needs to work in. So obvious consolidation needed to occur. Next, chart 56, here's the zoomed out view. Again, we broke a 35-year channel here, going back to 1987. So Interest rates are going to be up long term now, guys. Sorry about that. If you're going to buy a house, you're not going to see those interest rates back in the 2% area anymore. Now, this did hit a resistance here at 3 in the threes. Maybe we pull back. But this broken trend line channel is now support, and then we'll probably launch another big rally off of it. All right, guys, that does it for there. Let's look at some market sectors. Chart 57, transports. They were down 7.5% last week. See that after they lost this big support here, decline, rallied, and this was a perfect area to short. The back test of this broken support became resistance. But again, you could see black candle doji, RSI divergence, a little CCI divergence. So if we can get follow through, then maybe we can get a rally from here. Next, chart 58, there's the long-term view. Again, don't get me wrong, guys. Any good rally will eventually be sold. You know, longer term, this is big resistance up here at 240. Down this range is a target over time and maybe even down into here. Next, chart 59, energy. This area is still holding in here. It's had a hell of a year. Hope some of you bought my recommendation on energy stocks back in January. They're still holding up for now. Next, chart 60, technology, XLK. Again, look at this big black candle doji on Friday. Went back to April 2021 levels. There is some RSI divergence here. Next, chart 61, communications sector. Black candle as well. Hell of a correction in this sector. Look at this. That contains some of these former FANG names. You know, we don't consider Netflix a FANG name anymore. Next, chart 62, financials. Kind of a doji here. Not a black candle, though, like the others. Trying to bounce at a little support here. This is your next long-term support down here. There's a gap from February 2021, which is a magnet. But can we bounce here first? We'll see. Next, chart 63, retail. Got smoked last week, down 9.5%. This is also not a black candle. Next, chart 64, real estate. You know the issues with this area is trying to bounce at a fib area. Long term, it will go much lower. Next, talking about real estate, let's look at some of the casualties. Here's Walmart. Look at this decline in Walmart. Biggest it's been since '87. Now, very short term, you got a black candle here. It's due for a reversion to mean, even back to the 9 EMA. So you bottom pickers, you knife catchers, maybe you can get a trade here. Put a buy stop over the candle, put a sell stop at the low. Next, chart 66, Walmart, monthly view. This goes back to 1997. Here's your next long-term supports. I do believe Walmart will get down to this 100 range eventually, you know, but who knows? Over time, it may get down to here, 75. Next, chart 67, Dollar Tree, also a big casualty last week, down about 20%. There's big support down in this range, though, 120. Next, chart 68, Costco, also got nailed last week, down 16%. Big support down here, and then another support down here. Next, chart 69, metals and mining. They bounced off their lows a couple weeks ago off the 200-day moving average. So far, they have not retested that. This was a big support down here. Next, chart 70, biotech. They had a doji candlestick last week, and you could have triggered long off that, off the high of the doji. If so, you would be long with a stop. Hell of a correction since February 2021. Next, chart 71, here's the daily view. Next, chart 72, here's a 60-minute view. I think you got a trade opportunity here. You got a flag. Here's a symmetry move, would project up to 76. Put a stop here. Next, chart 73, materials. Now this area still looks pretty damn weak to me, guys. A lot of resistance up here. And if it breaks this support here, you know, this is easily dump way down into this range. So there's a look at the sectors. Now moving to commodities. Chart 74, here's the CRB to the S&P ratio. So you can see how commodities have outperformed this year. Look at this ratio. Look at the moving average ribbon expansion. So what I talked about late last year has been playing out. Commodities have outperformed this year. They're up 30-something, 35% versus the S&P down 20%. So now this will ebb and flow. So maybe it gets a little extended here and you get a little pullback in the ratio. That would correspond if the market bounces. But longer term, this is the big cycle. You know, this looks like it could go, you know, be on a trend to last for, you know, 2 or 3 years. Next. Chart 75, there's the monthly view of commodities. Again, hell of a move from the 2020 lows. It is quite extended up in here. So like I said, eventually these will be due for a healthy consolidation. This area here is now long-term support. Next. Chart 76, here's the daily. You have a coil setting up here. Watch this. If this were to break out of the coil, market might not like that. That would likely correspond with a move up in crude oil as well. Next. Chart 77, here's crude oil. So far, we've had a little choppy uptrend since we've had this blow off top. So kind of looking at a channel so far. Next. Chart 78, Brent crude oil. This is a cleaner pattern, more of a coil. By the way, so energy is building, and BNO is the ETF if you want to trade it. Next. Chart 79, copper. Weekly view was up for the week, but it's testing this as resistance. You know, assuming we're in a recessionary environment now, you know, this could work lower. Next. Chart 80, copper on the daily. Rallied off the low here. I talked about the moving average ribbons being too wide, needing to work off. But it's kind of a bear flag look to it. Next. Chart 81, DBA. Kind of a choppy uptrend channel here right now. Still holding the 50-day. Next. Chart 82, there's the ratio of DBA to the S&P. So kind of like the S&P, the CRB to the S&P. You know, this isn't a nice uptrend. Came out of a base. Commodity or agriculture has been outperforming the market, but it is a little extended here now. Notice that it's on a ratio. Next. Chart 83, here's a monthly view. So again, look at this move out of this multi-year channel, moving average ribbon. But notice we're up at this long-term resistance going back to, I don't know, 2015, 16. So this could be an area to maybe pause if it wants to do so. All right, let's move to cryptocurrencies. Chart 84, here's Bitcoin. So we need to see Bitcoin rally. If we can get above this 9 EMA here, you can see it's been stalling price. Get a rally up, that'll help the market bounce. Next. Chart 85, here's a 2-hour time frame. I want to see it. It needs to really break up out of this pattern. If it weakens and breaks down here, that would not be good for the market, guys. Bitcoin leads. Next. Chart 86, here's Bitcoin on the weekly. I've showed this before. Symmetry projection eventually targets and move down to 12,500. All right, but I don't think we go there now. If the market can rally, maybe we get a rally in this lower high, but eventually it's coming down here, folks. Next. Chart 87, Ethereum. Similar to Bitcoin so far. Has it not been able to get over the 9 EMA? Watch this carefully. Next. Chart 88, US dollar. So far pulling back from that rising wedge we showed last week ago. RSI divergence. This is a support. If we can break that, then the dollar could pull back to the 50-day. That would help precious metals. Next. Chart 89, here's a monthly view going back to the 90s. You can see how this area in here is a resistance area. Got a doji candlestick so far. Next. Chart 90, here's the euro. That head and shoulder pattern we talked about last year obviously played out. You know, if the euro can rally, this would be your long-term resistance now. Next. Chart 91, Japan, yen. They continue to inflate, but they're also bouncing now. Ribbon's pretty wide here. Maybe this needs to work off with some upside move. Finally, let's move to precious metals, guys. The final part of this newsletter video. Chart 92, gold, weekly view, up 1.9%. Right now it's trying to hold this trend line. Gold's been frustrating for bulls. You know, had a little double top back here and all the way down to here. Really needs to hold this area in my opinion. Now, moving average ribbon, it's starting to pinch here, so keep an eye on that. Next, chart 93, here's gold in the daily. So we got into this demand zone. We bounced. You know, again, it got a lot of work to do here. If it can hold up in here, higher or low, that would be a positive. The stocks are outperforming here. This is the GDX-GLD ratio. That's a positive. Gold tends to do this, guys. Gold's better to buy in these dips like this versus chasing these rallies. Next, chart 94, silver, bounce, but this one still looks ugly to me, kind of a bear flag. Next, chart 95, silver on the monthly. We lost some support here. It's resistance. My worry is if silver needs to come down to this area. That's your next big supply or demand target support zone. Next, chart 96, GDX, the miners. Again, they've been outperforming here the last week and a half. That's a positive, but, you know, on a pullback, you want to see a higher low now. Strong decline from April highs, though, obviously. If the dollar can sell off, maybe that'll help gold a little bit. And next, chart 97, here's the 2-hour view. We pointed out this rising wedge back in April, and that played out. Now, watch symmetry here, guys. This rally off the recent lows was larger than this one. So that gives you some higher odds at a higher low forming in this area. Next, chart 98, here's GDXJ. That's another one. Now, this clearly broke symmetry. So this looks a little better than GDX. I would look to buy a higher low pullback on this. Next, chart 99, there's the weekly view of GDX. Again, this stuff has been a trader's market. You know, if you don't sell rallies up in here, you know, you're not happy. But there's a chance that this stuff can start building the base down in here, perhaps. Let's take a look at a few individuals that stand out. If the area does hold up, here's Newmont. It's had a nice correction from the spinning top doji. Got near the 200-day moving average, so it's a more of an attractive area if this area holds up. Next, chart 101, RGLD, another one right at the 200-day moving average. You've had a really good correction here, so if you can get a trigger with a tight stop, you know, it may be more attractive. Next, chart 102, GFI, Goldfield, same deal. It's down around its 200-day moving average. So there's a few that stand out if you want a few individual names. Moving on, chart 103, BMY, one of the ideas from Time Band. It still holds up in here. Needs to take out this resistance and hold the 50-day. Next, chart 104, DSX. You know, the shippers, this was a long idea of mine a week and a half ago. It's been holding up. Has a cup and handle look still here, too. Next, chart 105, Apple, Crapple. You got a big black candle doji. So just like the indexes, if we can get a move above that high, a good strong candle, that would be a morning star. Next, chart 106, Walmart. Like I discussed, you have a black candle doji. Reversion to mean setup here. You have an objective long setup as well. Next, chart 107, Walmart. Here's the 60-minute time frame. You can see the little divergence here. I'm long a little Walmart right now. I got to stop at the low of this tight little doji. Next, chart 108, Labu. That's the triple for biotech. Like I said, it has a bullish pattern on this time frame. Next, chart 109, Netflix. Some of you knife catchers. This does look like it could be an area to bounce. Put a buy trigger right over this area. And finally, chart 110, UPRO, triple long for the S&P. Like I said, we have a black candle doji. You have a long objective trigger at the high of the doji, and you'd put an immediate stop at the lows. You have some RSI divergence. You have some MACD divergence. So it is an objective setup. And, you know, there you go. Now, what you'd want to see, you want to see a strong candle move up as a for a morning star as a confirmation. So we'll see if we can get those, but there's a couple ideas for you guys. And we'll see how futures open tonight and how the market does this week. Take care.